Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of SNN or its affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable. Our guest on the show this week is Tim Call, the president and CIO of the Capital Management Corp, a long-only investment firm that focuses on cash cows. The firm has been around since the 1960s and has remarkable client retention numbers. In this enlightening conversation, Tim and I covered the lasting legacy of the firm, what a cash cow means to CMC, why they think SMID cap is a great place to be investing, the philosophy surrounding portfolio concentration, and how to get the most out of a small investment team. And without any further ado, here's my conversation with Tim Call of the Capital Management Corp. Tim, this company's been around since the 1960s. How does that legacy inform what CMC focuses on and does today?
It corresponds with how we have a long-term approach. And it's interesting with the clients, the patriarch of the family we had 60 years ago is now long gone, and the grandchildren are the patriarchs. And they heard from their parents and grandparents how well we were doing, how great things are. And they get to know us. We get to know them very well. And that makes the relationship rather sticky. It helps to have good performance. And then they get to talk directly with the decision makers, with the investment professionals. When they have an investment question, we have the answer. So we know our stocks intimately. And I think that helps preserve the relationship. So the investment people like to think that it's performance related and results related, and the rest of our staff think it's service related, and they think it's great service, which it is. So it's terrific. On the flip side, the weakest part of the firm is we've never really had a marketing department. So here we are, and not everybody's heard of us.
Nothing wrong with that. Put up performance and people will find you in a lot of ways. So very few investment firms make it anywhere near as long as this one has. What do you think are some of the elements that have allowed this firm to persist and also thrive especially regarding how much the world has changed since this business was first started?
Well, the research is based on what's been proven to work long term, and it used to be done by hand. A lot of that can be done by quantitative screening now. So we take what trades in the United States, what reports to the SEC regularly, and from those roughly 4,000 stocks, screen out what's growing their earnings and growing their excess cash generation. And we can get the results down to less than 10% of the whole universe. And these are what we consider growing cash cows. They don't change from month to month and year to year that much. You get pretty much the same list. And so there are 200 or 300 companies that we get to know to various degrees. And then we apply our valuation disciplines if we think that these are the companies that will continue to dominate a growing niche. So when there was a generational transition that needed to take place, they wanted somebody with the exact same methodology. And sometimes that's hard to find. And in a day of, maybe you and I come from the MTV generation, so we have all of our compatriots have a 3 minutes of patience, and now we have the YouTube and shorter time frames for people. It was very hard for them to find an exact match. They were drawing from over 3,000 names and coming up with portfolios of up to 50 stocks. Where I was, we were drawing off 1,500 names and having similar output, 40 to 50 stocks. We compared our list. It was over 50% overlap in what we held. And what they held that we didn't, some of those had screened through for us, and we paid attention to those, had seen those before, and vice versa. And so we had great discussions, but we knew from the get-go we had the same approach. We were doing the same thing. We were adhering to our disciplines, and that was very important. They wanted to preserve their long-term track record and have it built upon, and they wanted the clients to be taken care of. So that's how we've been able to continue with the same approach over time.
And when that transition was made, obviously no two investment firms are exactly alike. Any other or any specific major differences that you would highlight between the way it was run before and the approach versus how you have kind of created this model?
Well, the firms that have hired me in the past have all said they're growth firms, but they've all been around for a while, and the clients that they've been able to keep get older and older and might need something other than 100% growth. And so there's a transition the clients make, and you need to move with that. And so there have been some grandfathered stocks along the way at these firms. And what I like to do is make that a separate product. Now there's huge overlap between the growth product and what we like to call the growth and income product, or equities that happen to have attractive dividend yields. And it's best to go ahead and formalize that process so that it saves time. There's a standard, and everybody knows what they're doing, and so that the clients receive the best results and service. They're following a product that the firm's spending a lot of time on. And so we have around 30 to 35 stocks in the growth portfolio, 30 to 35 in the growth and income. And in total, the approved stock list tends to be around 45 to 50 names. And that way it's quite manageable for us to know those companies intimately, to be on the calls, to talk separately off the calls with management, to read all the 10Ks, 10Qs, and be on top of all the press releases. And we love it. That's what the investment department here is all about. We tend to know the companies usually a little bit better than the brokerage firms do.
Mm-hmm. I appreciate all that background. I think it's a good time to jump into the strategy itself. You mentioned the strategy involves investing in cash cows. When I think of that concept, I picture a business that generates cash but can't really grow organically or has a limited reinvestment runway. In what ways would that perception be accurate or inaccurate as it relates to your portfolio?
Well, it's accurate that we have cash cows, so excess cash generators. When we look at what's trading in the United States, the 4,000 stocks, less than half of them generate excess cash in the first place, which that's in a good year. So imagine in a recession year, that's pretty scary. Wall Street loves that because Wall Street makes a lot of money underwriting bonds and stocks. And companies that are cash starved or losing cash, they need to issue new stocks and bonds. And Wall Street has a big broker system and can write up nice reports and feed it through all of their thousands of brokers. We like the opposite type of stock. So right away, the universe gets cut by more than half, just looking at the cash cows. But you're right, we don't want the average cash cow. We want the growing ones, the ones that have recurring earnings growth and recurring excess cash generation. And we want to see growth in that excess cash generation. We want to see a lot of cash generation relative to the size of the company. And we do research to try to figure out if that will continue, if that company will continue to dominate a growing profitable niche that itself will continue to grow. And there are mistakes along the way, but there's a lot of success, and we have a lot of fun doing it. With all that cash the companies generate, they can buy other companies, make niche bolt-on acquisitions. They can reinvest in their own growth, R&D and CapEx. They can pay down debt. We love it when they pay it down as it comes due. They can buy back stock, which boosts earnings per share. Around half of our companies happen to have buyback programs, and they can pay dividends and raise their dividends. Around 70% of our companies happen to pay dividends. And I like it when they do all of the above. Each of our companies has a different mix depending on what their opportunity sets are. And some companies, they only make acquisitions when they come across the right event at the right price, and it doesn't happen every year. Others are small and can buy very small mom and pop run companies, and that's extremely profitable. The average acquisition doesn't tend to work quantitatively. The seller happens to know more than the buyer, and so whether they are upfront or not, on average, it doesn't tend to work the first couple of years. But when it's a smaller company buying a mom and pop, usually they know a lot, and the seller wants the firm to succeed, wants the employees left behind to do well. And there are synergies. You can take the smaller company and feed it through the marketing of the larger company, the distribution. You can scale it up. Maybe the acquirer is national or international, and the acquired company is local. So there's a lot you can do, and it can be very accretive. And so we don't want to see the average holding just making acquisitions. We'll prefer that they have disciplines and thresholds. And so if they're buying back stock and paying down debt and raising dividends, it gives them, there's a little bit less cash than there would be otherwise to make acquisitions. So they have to be selective. And when that great opportunity comes along, well, they can go ahead and buy it, because not only do they have that extra cash flow, they can take out some debt because they've been cleaning up their balance sheet since the last acquisition. And so we like to see that discipline and the higher thresholds for acquisitions. We think that's important because if you're constantly making acquisitions, not only is it stretching your finances, but it's stretching your workers, your management, and your systems, and you might lose track of a few things. That's not optimal.
And given the amount of cash these companies are generating, it occurs to me that the difference between a successful investment and an unsuccessful investment is how that capital is reallocated into other areas. So you've mentioned buybacks and dividends, M&A, opportunities for growth. I'm curious about your process internally for assessing capital allocation, especially when you're looking at a new investment that might fit all of your criteria, generates a lot of cash, but then you have to be really comfortable with the allocators there. So what does that process look like?
We look at its history with acquisitions. Has it been successful? What are the size of the acquisitions? Which types of acquisitions add value to that company? Do they need to add another leg to the stool, which tends to be quite risky when you do that, when you're adding on a new silo of businesses? We'll prefer niche bolt-on acquisitions. So we look at that history. We see the history of buybacks and dividend increases. Are they being opportunistic when they need cash for other items? Are they slowing down the growth rate of their dividends? Are they cutting back on the stock buybacks? Are they buying back more stock when they're at a lower stock price versus when they're at a higher stock price? We have one company that when they're at a high stock price, they pay special dividends. When they're at a low stock price, they buy back stock. So we love to have the management think of themselves as shareholders. And when the company is larger, that might happen more often. When the company's smaller, these tend to be more operating guys. They know their business. They know what the business is doing. They don't know how to necessarily optimize the company for a public shareholder base, and in which case we give them some advice along the way. Usually give a lot more advice after we own the company, but we can give advice before then too. And sometimes it starts just with the questions: why are you doing it this way? So we like to know how management thinks and whether they're trying to optimize for shareholders. And hopefully, if we think there are improvements that can take place, they'll listen to us over time. Usually, it takes repetitive tries, but eventually some of the ideas get incorporated.
And now that we've discussed the cash cow focus strategies, cash cow's focus in general, I want to discuss the strategies. So capital management offers a number of strategies that look more like different flavors versus something totally different. You mentioned, kind of the growth and versus growth and income. Maybe just describe those two buckets and how they're different and similar.
So there's heavy overlap in names. Obviously, the companies that don't pay dividends can't be in growth and income. For growth and income itself, that strategy, we try to have a threshold where to buy a stock, it should have a dividend yield of at least 2%. And then if it's a higher yielding stock, chances are it's a higher percentage of the growth and income portfolio. If it happens to be in the growth portfolio, it might be a much smaller percentage of that portfolio. And so even though there's heavy overlap between the portfolios, the different weightings of holdings make it so that they, on a short-term basis, whether quarterly or annually, they perform rather differently. With the combined holdings, let's say 45 stocks, you can sort those many different ways. So instead of sorting by dividend yield and what's yielding over 2%, you can sort by the dividend growth rate. And so get it, our dividend growth portfolio, we call it dividend appreciation. You can sort by market cap. And when it's under $10 billion in market cap, we put it in our SMID portfolio, small and mid cap. I think most of Wall Street thinks mid caps can be over 20 billion, but we tend to think of them as 10 billion or less. And for our SMID portfolio, the average market cap tends to be around 2 billion. And that's hard to find when you're looking at mutual funds. When you do find a successful small cap mutual fund, usually it's over time, it's accumulated so much money, it can no longer invest in small caps. It would move them, or it would own so much of a small cap that they'll have a hard time trading it or have a hard time with the regulators. You really don't want to own over 20% of a company. And so you can find small and mid-cap managers with great long-term track records, but they're no longer investing in small caps. They're more of a large mid-cap manager or a small large cap manager on a forward basis. So anyway, we love researching, getting to know, and being rewarded from investing in small and mid caps. It's a lot more fun than investing in large caps. Now, we're opportunistic. We don't have restraints in that regard. So we tend to have a mix between small caps, mid caps, large caps. It's the opportunities that we find, and as they present themselves, usually our all cap portfolios like growth and income are roughly half large cap and half small and mid cap. But because of the recent market dynamics, being late in a large cap growth cycle, a lot of the large caps are overvalued right now, especially the mega caps. And so right now our all cap portfolios are closer to a third, and large, mid, and small. And we only have one mega cap. So it's interesting dynamics, but we're not stuck in a box. We don't have to mimic an index or have a bunch of companies that might be average or we believe below average just to check a box. So it's quite rewarding. And when we find great companies with terrific outlooks and attractive entry prices, we can take advantage of that. And having a portfolios where they only have 35 names for the all cap portfolios, they might only have 20 or 25 names for some other strategies, like our SMID portfolio. That means that when the stocks perform like you think they should, you get rewarded. The portfolio directly benefits. We had 5 to 10% of a small company that got taken over, and it added a couple percent to our account performance, which is terrific. The one I'm thinking about last year provided a great return. We did have 5 of our holdings being taken over last year, which is unusual. And so far this year, 2, which is more typical. We utilize a fund family for small accounts that need instant diversification, that just, that might be a grandchild's account or what have you. And so we've gotten to know this fund family rather well. It's a very, very, very large active fund family, and they only have one small cap fund, a global small cap fund, and they were sometimes the second largest non-insider in that stock. And sometimes they own 5% or 6%. The only way you could tell is when you look at the prospectus. It wasn't one of the 100 or 200 stocks listed. There was a footnote. They had to put a footnote in because they owned over 5% of a company. And so it was such a puny part of the overall fund that's all it received. But when looking at it and measuring the size of the fund, if that stock doubled, it really didn't add anything to the performance of that fund. Now, they didn't have it in its final months, so they didn't get the takeover. But they just can't invest in small caps. So even though it's called a small cap fund, even though we've gone to the fund company and told them for the last 15 or 20 years they need to rename it the large mid cap fund, and they won't do it. It's just physically impossible for them to have a meaningful or enough of a meaningful position in small caps. So it's an oddity. Money's going to come back into the small cap and mid cap space. Either it has to be indexed, or if it's chasing good long-term track records, it's probably going to find itself in more large mid caps and small large caps. But we're loving going through this research and enjoy finding these smaller companies. I remember doing it near the end of the last large cap growth cycle in the late 90s. And there were analysts covering these stocks in New York, the sell side brokerage firms, but no one cared. And I was in the office of who I thought was one of the best brokerage analysts for hotel stocks of all things. And I went through the case for this small cap hotel, why it has the best fundamentals of all the hotels under their coverage list. He says, Tim, you know the company better than anyone. You're absolutely right, but no one cares. And so you had the analysts, but no one cared. Now, at the end of this large cap growth cycle, you don't have the analysts covering it. Wall Street over the last 20 years has cut back on the analysts. So the large firms don't have small cap analysts. Some small companies have to kind of pay one way or the other for research from a specialty house. If they're lucky enough just to get research on its own, the analyst usually is very young, doesn't have much experience, and is probably spread too thin. It has lots of companies to cover in various industries, so it doesn't have the industry knowledge and doesn't have the company, long-term company knowledge, hasn't been through the cycles. And then, the analyst might be living with, sharing with 4 or 5 of their friends an apartment, 1-bedroom apartment in New York, and the other friends get promotions or make their bonuses and move out into larger spaces. And the small cap analysts, they got to decide whether to switch careers. They're not getting rewarded for what they're doing, and all of a sudden the analyst changes and you get another 21, 22-year-old who doesn't have any experience covering the stock. That makes it so they're just extraordinary opportunities. So not only have small caps and mid caps been left behind, and dividend payers and value stocks and cash cows, but there's not much work being done on them. There's not much coverage. There's not much attention. You can't find much information. Somebody has to do their own work and go through all the SEC documents and try to get through to management. And there are not many firms doing that in the actual small cap and mid cap space. And so the opportunities are greater because of that. There's more being overlooked. The valuations are even lower than typical at this point in a cycle, but cycles tend to be recurring. And I like to think of it as these cycles as occurring on a rubber band. And so if you have large caps over 100 years going up 10% a year, and mid caps 11%, small caps 12% over 100 years, you have rubber bands, and right now the mega caps are extended. They're way up high, and the small caps are extended the opposite way. And eventually you get to an extreme, you get the snapback, but the rubber band won't just stop at the imaginary ruler. It will go right through to the other extreme. And so not only do you get the long-term earnings growth and compounding of that, and likely dividends as well, but you get the valuation multiple expansion. And so from a greatly oversold level, if you find growing cash cows, you can benefit from that long-term growth. And at this point, we believe an extremely large expansion in valuation multiple. So not only going back to normal valuation multiples, but then going to the other extreme. Because when the consultants and all the other experts, 5 years, 10 years into a cycle, say, "Oh, you're underweight in small and mid caps or value or dividend payers," they say that after those areas have recovered, and those areas are starting to get attention, starting to get expensive. And as that institutional money comes in, the area becomes more and more expensive. And so there's a lot of money to be made. This time will be more extreme than the previous occurrences. When I think of the previous large cap growth cycles, the roaring 20s, the Nifty 50, the Y2K.com eras, if you sold the largest company, you couldn't buy half of the S&P 600 of all the small caps. Right now, if you sold one mega cap, you could buy, in theory, the S&P 600 twice. And there's liquidity in those mega caps. You see Warren Buffett selling 1% or 2% of Apple every so often, over and over again. And he's loading up on some treasuries, but then on the side, he might be buying some small mid caps, and he tries to get permission to not report on a timely basis. But one of the mid caps we hold right now, Sirius Radio, he's buying a lot of, and just imagine when some of this large cap, some of this mega cap money moves into other areas of the market. It might not greatly affect the large caps, but it will greatly affect the stock prices of all these other areas. You start buying several percent of small and mid caps, the question becomes, who are you going to buy those from? And in the case of Sirius Radio, you have John Malone and his group of investors indicate they're long-term holders. You have Warren Buffett buying 10, 20, 30%. There's no room for anybody else. So you have a lot of shorts in there. I don't see how they're going to cover. So Warren Buffett, I believe, will keep adding to his stake. We have a nice stake we might add to. Eventually, that company will continue to have long-term growth, generate tons of cash. It's reinvesting in itself, throwing up satellites in the sky. It's going through a big satellite replacement period right now that ends in a year or two. And after that, its free cash flow grows much faster because it doesn't have all that capex, and it has the money to buy back stock, pay down more debt, and the valuation multiple will expand as it gets more revenue from the newer satellites and their features. And the shorts will have to cover. I don't know who they're going to buy back from. If Malone's groups and Warren Buffett aren't selling, so it's a good problem in the future, and we see that with a lot of our companies. They're very attractive companies, generating lots and lots of cash. And when the market changes direction, when leadership changes, when money starts moving back in small and mid caps, the valuation multiples of those growing cash cows should expand a lot faster than the valuation multiples of other small and mid caps.
Well, you anticipated a bunch of my questions about your SMID cash cow strategy and why you're excited there. And a little bit, you talked a lot about why the next 10 years for small and microcap or small and SMID will be better than the last 10 years. So thanks for all of that. I'm curious, as you're allocating time between the team and you're covering, especially smaller stocks where there isn't brokerage research and there's a fair amount of more extra kind of digging that needs to be done. How are you splitting up the team to focus on everything from mega cap all the way down to small cap? How does that work?
Well, we have those quantitative screens that help us narrow it quite a bit as to what we want to look at. And then when you have those 200 or so companies that come through, you get to know them well. The growing cash cows don't change much from month to month. So it's a list that we highlight the new names each month and the names going off each month. But the vast majority stay there. So you get to know the companies, and some of them you've owned before and you might own again. And others you learn more and more about over time. When it comes to being able to research a stock, seniority helps a lot. But beyond that, some of our people have industry expertise. And so first we defer to them. So if they want to go forward with it, or if they have a strong objection, we take that quite seriously. That if there's a problem or roadblock, then we shouldn't spend that much time on it. And beyond that, it's how much interest there is in moving forward. And if the team says that sounds good, but one person is more interested, we'll want that person to move forward with it. In the rare case that two people are extremely interested, well, that makes things easier when you go through earnings season and when news breaks and so forth, to have two people that deep into the stock. So we get to know all of our stocks. We share the information, but it really helps to have somebody extremely interested in the name. And it's also important that no one be emotionally attached to any of the names. One thing that helps with that is, I've heard it before at other firms, it might not be true at other firms, but if we sell a stock, we can always go back to it later. And at our firm, that's the case. And we've done that with several stocks. We're doing it with another one this week. One, I never thought we'd have the opportunity to buy it again because it was a small cap that became known, and the valuation went up, and I thought we'd never get a good entry valuation on that stock again. And here we are many years later, and it's tripped up and it's starting to rebuild its track record. And we know from following it for 2 decades, this is a great opportunity. And so in that case, the person who knows it the best already moves forward with it. How we've structured the firm and the reward system is that it's a team environment, but also you quantitatively, you do get rewarded for being right and adding value, and you do get dinged, you get penalized for detracting any value. And so if you're going to recommend a stock, then you're going to believe in it, and it's going to affect your future finances. But we hold people accountable, and we also do operate as a team and reward teamwork, and we meet regularly for formal investment meetings each week, and then we can have a hallway meeting anytime. Hopefully not now, but the door's closed. Usually it's open.
Yeah, and another way that you can kind of slice and dice the names that you own, and you kind of highlighted this, is based on concentration. Right, like can you own enough of a stock to really move the needle if it goes up? So I'm curious. You mentioned about maybe weighting higher dividend yielding companies in the dividend strategy, but how does that concentration? How does your conviction lead to either bigger position sizes in the broader strategies, or that position being also in a concentrated version of that strategy?
In a in a less concentrated strategy, we think of a 4% position is rather big, and that would be a full position for a large cap, and for a smaller mid cap to make it to 4%. We would have to have enormous conviction in it, and we would expect it to have, we'll be projecting higher, greater upside for that stock than a similar large cap with that same weighting. For a more concentrated portfolio, positions could be closer to 5% for the higher conviction names. And obviously, if it's a SMID portfolio, then there are no large caps. So you will see lots of roughly 5% positions, 4 and 5% positions. And so when the valuation multiples expand, when you have big earnings surprises, when a company gets taken over, it meaningfully affects the overall portfolio. And so we have lots of big examples of that. And starting to come out of the financial crisis. So in 2009, so the market bottomed in March of 2009. Later that year, one of our specialty insurance companies had tripled, which pretty good return for 6 months. Another specialty insurance company, a different specialty, but had many of the same drivers, and they're in the same industry. It hadn't moved. And so all of a sudden, one was a huge, enormous holding, and the other was just normal size, maybe a little bit less than normal because the rest of the portfolio had grown. But both companies had similar fundamentals, other than one just had its valuation trouble. So we trimmed that one heavily and put the money into the other insurance company that hadn't moved. And then over the next 12 months, that one doubled. It's ridiculous. And you shouldn't have individual companies moving like that for no great reason. But you have money flows, and the money flows affect the stock prices greatly. And when we start to see money flowing back into some of these areas, like small and mid cap value and dividend payers and cash cows, we're going to see some big moves in the stock prices. And we've just started to see interest come back into that space. There have been times where leadership changes mid-year. I'm thinking 1994, right before the Congress changed and Newt Gingrich became Speaker, and it was when the Clinton presidency stopped pushing healthcare. You had a big inflection point in the markets and in leadership. Usually these changes, for whatever reason, have happened closer to year end. But we did see the small and mid caps pick up starting in July considerably. I think we'll once again see it in the Santa Claus effect, and Santa Claus rally and the January effect certainly help. But a big reason for momentum and leadership to change is that the past leaders start seeing a deceleration. So revenue growth can decelerate, earnings growth can decelerate, and even NVIDIA, the largest market cap in the world, that is seeing its revenue growth slow. So it might still have good revenue growth, but it's slowing, and its earnings growth is slowing. It's decelerating. It's the second derivative. So the second derivative, that change happens to be very meaningful when it comes to stock prices. And we're seeing that with the mega caps. And sometimes you have a lot of lead time. I mentioned Warren Buffett selling a lot of shares of Apple. Well, that stock is usually at 12 to 15 times earnings, and it's usually growing earnings at 10 to 15%. Well, right now it's closer to 30 or 35 times earnings, and it's not growing its revenue or earnings at any material level. Those are warning signs, and that's a huge deceleration. So you have an extended stock, very overvalued, and you have a deceleration of fundamentals. With NVIDIA, you can say, oh, it's still growing, but it's the largest market cap company in the world. So there's a lot of room to fall. It's had two previous occasions where it's fallen more than 80%, and that's meaningful. You have to make up your money, you have to grow by over 400% to make up for that. But at the end of the last large cap growth cycle, you had some companies decelerating. You had warning, plenty of warning, and plenty of time to sell. There were the large caps like Coke and General Electric, but obviously there are the tech stocks too. And Intel was the largest chip company then, and you had Cisco Systems. And they're great companies. They're great then. They're great today. And people said, "Well, gee, you have to own them. They're going to be the leaders of the future." Well, if you bought them in late '99 or 2000, here we are 24 years later, and you would have they're at a lower stock price now. So that's not a good 24-year return. So Intel is still massive, and NVIDIA might be massive in 24 years. I think buying it today, you're just paying too much for it, and it's probably not going to be the largest company in the world in 24 years, and other companies are trying to compete and create technology, and things happen. So we think there's a lot of risk and overvaluation in those mega caps, but we see that deceleration of fundamentals occurring right now. And there's acceleration of earnings and fundamentals in other areas of the market. And we've had a rather slow economy. It depends what government numbers you look at, or if you pay attention to revisions. But there's plenty of room over the upcoming years for the economy to start to grow again. And in that case, other types of cyclicals might lead the stock market. And when you look at financials and consumer discretionary companies, a lot more of them are small and mid cap. So when you look at the makeup of a small cap or mid cap index, they have a higher weighting in financials and consumer discretionary than the large cap indices. Now, of course, sometimes that depends on how S&P moves companies around, like moving Alphabet or Google to consumer discretionary and to communications, and Amazon to consumer discretionary. That helps lower the tech weighting and raises those sectors. But anyway, nuances. We've been here before. So at the end of the Nifty 50, people said you had to own these certain tech stocks. They're the future. It doesn't matter how much you pay for them. And so you were supposed to, no matter what price, buy Polaroid, Xerox, Kodak, and that was the future. And all you had to do was buy them, and you'll be fine. And at the end of the 99, early 2000, it was the four horsemen, the last ones to go off the cliff. And now here we are with the mega caps. And we've seen these cycles before, and it's very exciting at the inflection points. But the market's strange. No one tends to buy at bottoms. It's the only area in the world where people don't go out and seek out companies on clearance sale. We have Christmas coming up. When I start my Christmas shopping on Christmas Eve, I go to the stores, and the clearance aisles, completely empty. The sale aisle, you're lucky to find anything broken there. It's very hard to shop on Christmas Eve, but people want sales. People want a good deal. except in the stock market. In the stock market, they think something's got to be wrong. We don't want it. There's an image attached, and it's quite unattractive to buy something oversold from an emotional standpoint. And the average investor regretfully buys high and sells low, and that hurts their returns. So right now, there's no interest in small caps and mid caps and cash cows and dividend payers, and that is a great environment in which to find those stocks and be fully invested. And we're very excited because we've seen this play out before.
And if I'm an allocator and I come into your office and I say, Tim, I love your thesis on small and SMID. Totally agree with you. No one cares. There's no analysts anymore. There's no money. The mega caps are overextended, all of that. But I think to some extent, if I'm an allocator, I want the returns to be there irrespective of whether a bunch of money sloshes around and pushes the stocks above, fair value. So what is your response to this being, these being attractive areas, even if you don't get that flood of late cycle money coming into the space?
Well, we've been working rather hard, but we've done quite well in all cap portfolios, and in our small and mid cap portfolios, we've made a lot of money, even though we're not in the favored segment of the market, the largest of the large caps, and so it takes a lot of effort. You're going uphill, with the wind in your face. We've been able to make a lot of money, and we've been able to generate results, and our clients have benefited from the recurring compounding. The difference that we see is all of a sudden, instead of going uphill against the wind, we're going to be going downhill with the wind at our backs, and it's going to be that much more fun. When this happened at the end of the last large cap growth cycle, our firm's clients tended to do well. On average, clients over that decade, 2000 to 2010, roughly double their money. And the S&P 500 index over that decade was down roughly 11% cumulatively. Well, doubling your money over 10 years, I think that's not too exciting for me. That's 7% a year on average, and I would hope when we have have this recur. The regulators don't like us saying history repeating itself, but when the cycles turn and we have something similar occur, I would hope we could have that differential be closer to 10% a year, not 7%, or having the difference take place over 7 years instead of 10 years. There's a big snapback, and I think we're at even lower relative valuations and have greater opportunities than what I saw in the late 90s and early 2000s. I saw some extreme opportunities then, and there's a lot of money that was made, a lot of 5-baggers and 10-baggers while the S&P was down 80% in a 3-year period, or at least the NASDAQ down 80%. It was quite a dichotomy, and you have that certainly near the end of the large cap cycle when the large caps are taking off, a dichotomy. But you have to remember that over a long period of time, value outperforms growth. Dividend pairs outperform non-dividend pairs. Small caps outperform mid caps. Mid caps outperform large caps. And so after a period where large cap growth does well, there's a rebound of the other categories. The rebound tends to be stronger or greater on a relative basis, relative to large cap growth. It has to be, in order for the long-term track record to be greater for those other categories. And the snapbacks are big, but they also tend to occur, the biggest moves occur early. And so by the time the experts become aware of these trends years later, most of the money has already been made. Now you can still do well and still compound at a nice rate, but the extraordinary amount of money tends to be made early on. And so it's exciting to see the signs of major inflection point of leadership right now, the decelerating of fundamentals for the mega caps and the strengthening fundamentals and catalysts in place for several different sub-industries where we have holdings.
And I never like to leave a discussion with a manager without talking about a mistake. Is there a mistake that you made that comes to mind that has forever changed the way you invest?
I've made lots of mistakes over time, and that's somewhat part of the business. It's a humbling business. And yes, you try to learn from your mistakes. One of the earliest learning experiences I had when my first employer in the investment world had a game where you pick 10 stocks each quarter. And so that they're equal weight. And out of the whole firm, the winner that quarter gets a couple dollars, not much, and the loser takes everybody to lunch. Well, you wanted a well-off person to lose, certainly. That's a whole other group of stories. But I would pick those 10 stocks. 10 different. It could be 10 different stocks every quarter, but I'll pick those using the same disciplines, the screening technology of what works long term, and so including the long-term earnings growth and cash flow growth. But I would come up with the 10 stocks, and I'll be disappointed that I had to make them equal weight. And I'll ask, can't we overweight some, or can't we have double weights on some? And so I'll be disappointed I couldn't do that because I had high conviction in two of them, and then just good conviction in the other 8. But over the period of years I was with that firm, did rather well in that game. But I noticed that the 2 stocks that I thought would do the best out of those 10 every quarter never became the top 2 that in that quarter. Sometimes they became the bottom 2 of the 10 for that quarter. They might have, hit their catalyst. They might have been rewarded a couple quarters later. So they were great stocks over 3 years, 5 years, but not necessarily for that quarter. And so I learned, don't put all your eggs or don't put all your money just in 2 eggs, I guess. But watch your concentration. Make sure you have the diversification between different industries and sectors. And there are old CFA studies that say you reduce or eliminate 90% of the unique stock risk if you have 12 holdings. So anyway, most of our portfolios have more holdings than that. But you can't get timing exactly right. You have to be patient, and long term you can get rewarded, but you have to make it to long term. So keep some diversification, and that is one of the disciplines, one of the things I learned early on. And if we have time, I can tell you you didn't want the less wealthy people to lose that game, or else you were taken to Golden Corral for lunch. And that was that was not rewarding.
Yeah, I hear that.
Yeah.
Well, Tim, this has been a really interesting conversation. We talked a lot about the cash cow strategy. We've talked about the attractiveness of small and SMID, especially relative to larger cap. We've talked about the regime change that you think is happening in the market, and I'm fascinated to see if that actually plays out. We'll close with the question we ask all of our manager guests, and I think you've already hit on a lot of these things, but I'd love to hear in the most, kind of succinct summary of everything. What do you think is the most exciting and interesting and underappreciated opportunity in front of the firm today?
Yeah, it's fully taking advantage of these oversold companies with recurring growth and excess cash generation. And I think we're doing it, and we have lots of examples. Some have low single-digit PEs, which is extraordinary. These are highly overlooked companies. The challenge is to keep the clients comfortable when the style is out of favor. And it's helped to have several of these companies being taken out, being bought out, other companies being rewarded for one reason or another along the way. So we've had strong results and compounding of results, and that's gotten us through to this point. Now we finally get to the inflection point, and so our disciplines have enabled us so that we have great companies with recurring growth, with ready for valuation multiple expansion that have been overlooked by others. We're ready for those early days where you tend to make the most money. And we've kept our clients with us, which is important, so they can benefit from that. Because the biggest enemy for an investor is normal human emotions. Gets you to fearful at bottoms, gets you so you sell at bottoms and get greedy at tops, and you want to do the opposite. And so to be able to hold on to the clients, educate them, have them be patient during the years where our style's out of favor, that has enabled it so they get rewarded when the style is in favor. So we're very excited about where we are, how we're positioned for that, and it shouldn't be long now.
Well, as a fellow believer in the kind of small, SMID, micro world, and someone who's enamored with some of the valuations and the companies that you can find in that space, I am wholly with you, and I'm hoping we do see this regime change sometime soon. So Tim, this has been a wonderful discussion. I think listeners will really appreciate hearing your perspectives. Thanks again for being on Compounders.
Thank you. Appreciate it.
Tim Call mentioned a number of securities on this podcast. I do not own any of them other than Berkshire Hathaway.